New federal tax law, signed in July 2025 under President Trump. It's being called one of the most consequential changes since the 2017 Tax Cuts and Jobs Act. Supporters say it simplifies planning and gives relief. Critics argue it favors higher earners and complicates the deficit picture. Politics aside, if you want to pay less tax in 2026, here are 5 smart moves to consider: what changed, who it helps, who it doesn't, and the traps to avoid. Why act now? Because tax rules live and die by thresholds, dates, and phase-outs. If you wait until filing season, most of the levers are already locked. Plan now, and you capture benefits others leave behind. First, if you're 65 or older, the standard deduction gets a meaningful bump. As an illustration, a single filer 65 plus could deduct roughly $23,750. A married couple with both spouses 65 plus could be around $46,700. At a 22% marginal bracket, that's more than $2,600 in potential savings. Here's the wrinkle: the extra amount phases out as your modified adjusted gross income rises. Think ranges like $75,000 to $175,000 for singles and $150,000 to $250,000 for couples. If you're near a threshold, a big income event, a one-shot traditional IRA to Roth IRA conversion, a large capital gain, even a lump sum pension payout, can push you over the line and make the bonus vanish. A smarter approach is to spread conversions over multiple years and calendar one-time income carefully in the year you want the deduction. Second, homeowners in high-tax states, New York, New Jersey, California, and others, should look closely at SALT, the state and local tax deduction. The new law raises the cap to about $40,000 for people who itemize, with small annual increases through 2029 and a scheduled reversion in 2030. Proponents call this a fairness fix for blue state taxpayers who face the old $10,000 cap. Opponents say it disproportionately benefits higher earners. Practical takeaway: if you itemize, bunch deductible payments in a single year, property taxes, and charitable gifts, so you clear the standard deduction by a wide margin and fully use the higher SALT ceiling. Caution: at higher incomes, imagine your modified adjusted gross income moving from $500,000 to $600,000. The benefit phases out. Don't stack a big Roth conversion or a major stock sale in the same year you're bunching SALT, or you may phase yourself out of the very advantage you plan to use. Third, charitable giving. Beginning in 2026, there's a small benefit for non-itemizers who give directly to qualified charities, on the order of $1,000 for singles or $2,000 for married filing jointly. Politically, it's pitched as encouraging broad-based generosity, but there's also a new limitation for itemizers. The portion you can deduct is measured against income in a stricter way, which may reduce the deductible amount for some donors. Donations to donor-advised funds or private foundations don't count for that small non-itemizer break. Direct gifts do. Translation: if you're planning a large gift, it may be more valuable in 2025 than in 2026. If you're a standard deduction household making smaller recurring gifts, the 2026 rule can still help, but read the fine print. Fourth, HSA, health savings accounts. Starting in 2026, HSA rules get more practical for day-to-day healthcare. Certain monthly fees, like direct primary care or concierge medicine, can be paid from your HSA on a tax-advantaged basis within a modest monthly limit per person or per couple. Telemedicine remains eligible without having to meet your deductible first, and having a direct care arrangement doesn't disqualify you from contributing to an HSA as long as you maintain a high-deductible health plan. Strategy: contribute early if you can, let invested balances compound, and pay eligible expenses from the HSA when it's efficient for your plan. Keep receipts. Reimbursing yourself later can be a useful lever. Fifth, health insurance marketplaces. From 2026 onward, open enrollment tightens. November 1st, to December 15th, with state marketplaces barred from extending past December 31st. You'll need to verify income eligibility for premium tax credits upfront, not months later. If your income rises mid-year and you don't update your application, you may have to repay excess subsidies at tax time. This part is controversial. Supporters say it reduces fraud and aligns benefits with real-time income. Critics say it creates more paperwork and surprise bills. Either way, sync your Roth conversions and capital gain timing with your health credit calculations, update your income promptly, and enroll early so you don't miss the window. Let's turn this into a simple checklist to use before 2026. Call your CPA or planner for a threshold review, the age 65 deduction boost, SALT, charitable giving limits, and HSA eligibility. If you're converting to a Roth IRA, map the total over multiple years. Don't blow through a phase-out in one move. If you own a home in a high-tax state and you itemize, pick one bunching year for property taxes and charitable gifts. Keep big income events modest that same year. Max your HSA where possible, pay eligible care from it, and keep your receipts. Tie your income planning to marketplace credits and keep your account updated. A few rapid-fire cautions. Expanded deductions won't help everyone. Some lower-income retirees already owe little or nothing and may not see change. A large one-time income event can be great, but pair it with a year you're not relying on a phase-out sensitive benefit. And with charitable giving, optimize timing for taxes, but give for the right reasons. Policy shifts aside, generosity outlives tax codes. Final thought on the politics: laws can change again after elections, negotiations, or budget reviews. Sunset clauses and phase-outs are features, not bugs. Build a plan that still works if Congress tweaks the numbers in a year or two. If this helped you make sense of the new rules, tap like, subscribe, and ring the bell. In the next episode, we'll walk through real-world scenarios: retiree, homeowner, donor, and HSA user, so you can hear how the numbers change when you move the levers. I will see you back here soon. I hope that you have an amazing day. Take care.